So we're moving on to insurance. In this case, we're talking about motor vehicle insurance and property insurance. What is insurance? Insurance is, again, protection against the possible financial loss. It gives you some assurance, some peace of mind, something that you will be able to either recoup your losses or somehow to be compensated for your losses. And it's based on the principles of insurance are based on utmost good faith, meaning that all the parties are acting as honest brokers. The principle of indemnity being, being the reward isn't the right word, indemnified, meaning that you're going to be given back, your loss, being compensated for your loss. Principle of insurable interest, that you're the one that has to be the one that is losing out on something. So it's your property, it's your vehicle that was harmed in some way, shape, or form. It wasn't someone else's. You're insuring your own property. Subrogation, meaning that you're going to allow the party to, you have the option to go after the other party somehow, some way, through their insurance, the other side's insurance, if you will, to be able to seek restitution. Principle of contribution. So you're actually contributing to this, meaning that you're doing the best you can to, you're the one that's the that was involved with this, whatever had occurred. Proximate cause, meaning that you can identify exactly what the cause was that happened. So say, for example, you had some property damage. Your home was struck by lightning. So you know what the exact cause was. It wouldn't have been from something else. So you're able to identify, to link some linkage with that, with the proximate cause. And finally, that principle of loss minimization. You're going to do your best to protect your property from further damage. The property that was, so if you had there was a tree fell, a hole in your roof, you do your best to get that roof covered so that the rain doesn't come through, for example, along those lines. Some pretty basic things, if you will. So these are all the principles. So again, this is reiteration of the previous comments that would be involved with that one. The various principles of insurance. Again, this is a little bit more elaborate, but same idea. So the idea of insurance, again, is that the insurance company or insurer is a risk-sharing firm that assumes financial responsibility for losses from an insured risk. The people that purchase the policy, the firm assumes a risk for a fee calling a premium, which the insured policy pays periodically. So you're paying premiums. So you have two sides. One is the party that's involved, yourself, and then there's the counterparty, which would be the actual insurance company. So the insurance company is taking on some of the risk that you, the property owner, has. So they're reducing the risk but at a cost, right? So there's risk is that uncertainty or lack of predictability, such as the loss that a person or property covered by insurance faces. The different types of risks that would be involved would be, the next would be peril, which is the actual cause of the possible loss, such as a fire, windstorm. Again, when we talk about proximate cause, windstorms, explosions, etc. So the peril that you would undergo that presents itself in that risk, when that risk comes to fruition. Hazard is the increased likelihood of loss, such as defective house wiring, things that you could prevent, some of the peril, perhaps the damage that would result from that. So hazard is going above and beyond, things that you're not doing your part to mitigate that, to reduce the risk. Pure risk is, again, the common risks are classified as personal risk, property risk, and liability risk. Insurable risk is the chance of loss, not gain, from something that happens, something that occurs, accidental or unintentional risk. Nature or financial costs of the loss can be predicted. Speculative risk, this is the chance of either loss or gain, such as starting a small business or gambling. So speculative risk cannot be insured against, right? That's uninsurable risk. So again, there's a risk management plan that all of us, people, individuals, households, businesses, etc., go through this risk management plan. So, evaluating what the risks are that are out there. So again, risk management is an organized strategy to protect those assets and the people that are involved. Techniques would involve such things as risk avoidance, not doing something that's risky, not driving too fast in icy conditions, for example, or driving, again, using the driving analogy, driving too fast, driving 60 miles an hour in a 30 mile an hour zone. So we reduce risks by having safety measures, as part of our living, if you will, wearing seatbelts, installing smoke alarms, eating balanced diets, and exercising, and so on and so forth. Risk assumption, like who is going to get that risk? Where is it going to go? Self-insurance, where we're foregoing buying insurance but insuring ourselves. Risk shifting, transferring that risk to an insurance company by buying premiums so that the insurance company takes a share of that risk, right? So deductible is the amount that, it's kind of that earnest money that goes along where you say if there's going to be a certain amount of damage, you're willing to pay for a portion of it too, which means that the insurance company would reduce its rates accordingly to help, as you would, as part of this deal, you're saying you'll take on some of the risk as well, a certain portion of it. So two types of insurance, if you will, property insurance and liability insurance. So major catastrophic events, homeowners insurance that you would have to protect your property, to insure your property, home, automobile, etc., and the damage that could be resulting from that could be injury to others and their property as well. So this is what we were talking about with the property potential property loss, including the contents of your home, for example, the risk of the physical damage that would be caused by the hazards, etc., that we talked about before, fire, water, smoke, etc. Risk the loss of use due to robbery, burglary, vandalism, or arson. And then there's the liability piece of it. The liability is legal responsibility for the financial cost of another person's losses or injury. So this is where that physical harm would be coming from to another individual. That's where the liability piece comes into play. So when we're talking about, again, liability, that we talk about it in terms of the different gradations of this. So negligence, when you're actually negligent, you fail to take the ordinary or reasonable care in terms of like supervising a child in a pool is a pretty harsh example, but along those lines where you're abrogating, you're not stepping up to your part of the bargain. You're not trying to prevent things from happening, doing some normal things to prevent things from happening, negative things from occurring. Strict liability, a person is held responsible for intentional or unintentional acts. Vicarious liability is when a person is held responsible for the actions of another person. So this would be for a parent, for example, responsible for a child causing physical harm to another. Your dog biting someone, your property, employer held responsible for an employee causing damage. That's the vicarious part, okay? So homeowners insurance coverage, for example, the house and other structures, any property, anything on the property, anything including, trees, shrubs, etc., personal property at home or while traveling. So your personal property that, something is lost or not lost, but is stolen or damaged or somehow, some way that would count as your personal property. Personal property floater, this was if you have something of high value, maybe like a musical instrument, rare coins, etc., you would make sure that you stipulate that you want to cover that, and you want to make sure that there's inventoried and documentation that it is what it actually is, that you're actually insuring something that is legitimate. The liability side of it, we're talking about, again, when we talk about liability, we're talking about people. Um, Medical payments, coverage for accidents for caused by you, your family members, or by pets to another individual or other people. Most homeowners policy provide the basic personal liability coverage of $100,000 or more. You can get an umbrella policy, which is advisable, where you could have $1 million or more in liability coverage. It can go very, very quickly. So it's, in most cases, it's not terribly expensive. It's probably not a bad idea. Specialized coverages, homeowners insurance does not usually cover losses from floods or earthquakes. You have to have special insurance for that, and that can be extremely costly, especially if you're in a flood zone or if you're in an area that's prone to earthquakes. Anti-concurrent causation clause. This is, again, when we talk about that proximate cause. If there are other things that are going on, it could be, it could be a lightning strike, but it could also be a tornado that comes through. So what was the actual proximate cause? So a lot of different things could be going on. Again, it gives the insurer the right to reject your claim if your home is damaged by several factors, such as, again, all the different things that we've mentioned before. It can get quite complicated and pricey, right? So real quickly, I want to talk about renter's insurance. Most people do not have renter's insurance. Again, only about 40%, 4 in 10 people have renter's insurance. It's usually very, very reasonable. And it's something that is definitely advisable to get if you are renting an apartment or whatever. It really can make a difference in terms of if there are things that happen, whether we're talking about property damage or if there's liability coverage if something happens. So you definitely you should get a rental insurance policy. There are different policy forms that we talk about. Homeowners insurance, homeowners 3 covers all risks. Tenants form, which was the homeowners 4, comprehensive form, homeowners 5, condominium form for homeowners 6, country home form, which would be homeowner 7. There are different criteria for depending upon what it is that your living arrangements are, if you will. Okay.